What if someone already knows that gold is about to be revalued to $20,000 per ounce, and they are positioning quietly before the world finds out? What if a small trade placed today could turn into billions tomorrow? And what if the market is leaving clues in plain sight? Recently, a very unusual spike appeared in COMEX gold options data. Suddenly, massive open interest showed up around the $19,000 to $20,000 strike price for December 2026. For many people, this immediately triggered one big question. Is someone front-running a gold revaluation? Welcome to Gold Silver Scope, where we break down gold and silver markets with logic, clarity, and real analysis, not hype. Let's start with the facts. The data comes from COMEX Gold Options, sourced through major financial platforms like CME and Bloomberg. What we are looking at is open interest by strike price for December 2026 gold options. And what stands out clearly is a huge concentration around the $15,000 to $20,000 range, especially near $20,000. Now here is where we must slow down and think like analysts, not speculators. Open interest does not automatically mean someone is buying calls. Every option contract has a buyer and a seller. We do not know who initiated the trade. We do not know whether this position is bullish, bearish, or part of a hedge. We also do not know how this position might be connected to other markets. There are reports suggesting that around 11,000 December 2026, call spreads were accumulated between $15,000 and $20,000. So what does that mean in simple terms? A call spread means someone buys a call at $15,000 and sells a call at $20,000. If gold rises above $15,000, the position starts making money. But if gold goes above $20,000, profits are capped. In other words, the trader benefits only between $15,000 and $20,000. Above $20,000, gains stop increasing. This is important. If someone truly believed gold was going far beyond $20,000, say $30,000 or $50,000, why would they cap their upside at $20,000? That detail matters. Let's look at the numbers. The estimated cost of entering this position is around $300 per spread. Multiply that by 11,000 spreads, and the total cost is roughly $3.3 million. That is the maximum loss. The risk is limited and fully known upfront. Now look at the reward side. The spread width is $5,000. Each COMEX gold contract represents 100 ounces. So $5,000 times 100 equals $500,000 potential per spread minus the $300 cost. That is about $499,700 possible profit per spread. Multiply that by 11,000 spreads, and you get approximately $5.5 billion. Yes, billion with a B. So for $3.3 million, the potential payout could be $5.5 billion. That is an extremely asymmetric trade. The payoff ratio is enormous, more than 1,600 times the initial cost. This kind of convex payoff is exactly what people imagine when they think of insider trading. So the structure is consistent with someone expecting a major move higher. It is long dated. It is out of the money. It pays massively if gold explodes upward. On the surface, it looks suspicious. But as analysts, we cannot stop at surface-level conclusions. We must ask deeper questions. If this were truly insider front-running of a government gold revaluation, would it really be this obvious? Would someone risk placing such a visible trade that can be tracked publicly? If this trade hits, regulators would immediately investigate. The payout would be too large and too public to ignore. Insiders typically do not act in ways that scream for attention. They diversify strikes. They spread expiration dates. They layer positions across different accounts. They make it messy and less obvious. Here we see a concentrated, visible structure. That makes it less convincing as pure insider activity. So yes, the numbers are dramatic. Yes, the payoff is massive. Yes, it is unusual. But unusual does not automatically mean illegal or insider-driven. In Part 2, we will go deeper into the put activity, the broader market reaction, and whether this trade really fits the insider narrative, or if there is a more logical explanation. Now let's go deeper. because this is where the story becomes more balanced and more realistic. If this was truly an insider front-running a gold revaluation to $20,000, we would expect to see very clean, bullish positioning. That means heavy call buying and almost no reason to touch puts. But when we look at the full options data, we see something interesting. There is also significant put-open interest at similar strike areas. This changes the picture. Remember, calls benefit from price going up. Puts benefit from price going down. If someone had certainty that gold would be revalued sharply higher, there would be no logical reason to buy puts. There would also be little reason to sell puts aggressively, because that ties up capital in margin for months. An insider with confidence would want maximum upside exposure, not unnecessary capital lockup. Yet the data shows strong put activity alongside the calls. That suggests this may not be a simple one-direction bet. It could be part of a larger structured trade. It could be a volatility strategy. It could be a hedge against another exposure. Or it could be a fund creating convex protection while balancing risk on the downside. This is why we must be careful with narratives. Now let's think practically. If someone truly knew gold would be revalued by policy decision, would this trade be the only signal? Probably not. We would likely see unusual activity in other markets too. For example, we might see strange movements in U.S. Treasury bonds. We might see unusual positioning in foreign exchange markets, especially in the U.S. dollar. We might see stress in credit markets. We might even see shifts in mining stocks ahead of time. So far, we are not seeing clear confirmation across those markets. Markets are connected. A major gold revaluation would not happen in isolation. It would impact currencies, bonds, commodities, and equities. The absence of strong cross-market confirmation weakens the insider theory. Now let's talk about the cost of the trade again. $3.3 million may sound like a lot of money to most people, but in institutional finance, that is not huge. Large hedge funds manage hundreds of millions or even billions of dollars. For them, allocating $3.3 million to an extreme upside hedge is completely reasonable. Think about it this way. If you run a macro hedge fund and you constantly ask yourself, what could break the system? You might want cheap insurance. Gold is a natural hedge against systemic risk. It protects against currency devaluation, monetary instability, geopolitical conflict, and financial panic. So this type of trade could simply be a lottery ticket or insurance policy. In finance, this is called convexity. You risk a small amount for the possibility of a massive payout in extreme scenarios. Many professional funds do this regularly. They buy deep out-of-the-money options that look crazy at first glance but serve as disaster protection. Now let's examine another key detail: December 2026 expiration. Why December? December is not random. It is one of the most liquid delivery months on COMEX. That means tighter spreads, deeper markets, and easier execution for large institutional players. Liquidity matters a lot when placing big option positions. It is also the end of the calendar year. Funds care about year-end performance reporting. Having the position expire in December allows them to close books cleanly before year-end statements. That is practical and professional portfolio management behavior. If this were an insider trade based on a secret revaluation event, would it be limited only to December? Probably not. We would likely see positioning spread across multiple expiration months, November, January, maybe even February 2027, to avoid being too concentrated and obvious. Instead, this looks structured and clean, more like a portfolio hedge than a secret gamble. Another important point: the upside is capped at $20,000. That means if gold goes to $25,000 or $30,000, the trader does not gain additional profit beyond the spread maximum. If someone truly had inside knowledge of a massive reset, why limit profit? Yes, one could argue that maybe they know the exact revaluation level, but that assumes a level of certainty that is extremely rare in real policy environments. Now let's step back and ask a broader question. What kind of scenarios could justify a hedge like this? There are many possibilities. A major dollar devaluation due to fiscal instability, aggressive monetary easing, a sovereign debt crisis, escalation of geopolitical conflict, rapid central bank gold accumulation, a systemic financial event, even unexpected black swan events such as cyber disruptions or global shocks. Gold is historically the asset investors turn to in extreme uncertainty. If you manage a large portfolio and you believe even a 5% probability exists of a dramatic gold repricing event, spending $3.3 million to potentially make billions is mathematically rational. This does not require insider information, it requires risk management thinking. Also, if an insider truly expected a guaranteed revaluation, the position size would likely be much larger. We would probably see tens of millions deployed, not just a few million. The risk-reward is so extreme that someone with certainty would likely scale aggressively. Instead, this size looks controlled, measured, strategic. So where does that leave us? So far, the evidence does not strongly confirm insider front-running. It also does not completely rule it out. What we see is unusual but not impossible within institutional portfolio management behavior. Now let's step back and look at the bigger picture. The real question is not whether someone placed a $3.3 million options trade. The real question is this: is a $20,000 gold revaluation even realistic in today's macro environment? For gold to move from current levels to $20,000 per ounce within this time frame, we would need something extraordinary. Not just normal inflation, not just a rate cut cycle. We would need a structural monetary shift. That could mean a major currency crisis, a sovereign debt event, an aggressive reset of the financial system, or a deliberate policy-driven gold revaluation. Historically, gold revaluations have happened, but they are rare and usually tied to extreme monetary stress. For example, when currencies are under pressure or when governments need to repair balance sheets, gold can become part of the solution. But these events are not casual. They are systemic. Right now, we are seeing strong central bank gold buying globally. We are seeing high sovereign debt levels. We are seeing ongoing geopolitical tensions. These are supportive for gold long-term. But supportive does not automatically mean explosive revaluation to $20,000 in a short period. Markets move based on liquidity, policy, psychology, and capital flows. A move to $20,000 would likely require either massive currency devaluation or a formal policy reset. That kind of event would affect bonds, equities, foreign exchange, commodities, everything. It would not happen quietly. This brings us back to the options trade. Yes, the payoff structure is extremely attractive. Yes, the convexity is powerful. Yes, the trade is unusual, but unusual does not equal secret knowledge. Large funds routinely buy tail risk protection. They buy extreme upside hedges in gold just in case something breaks in the system. From a portfolio management perspective, allocating a small percentage of capital to an extreme hedge is rational. It is not emotional. It is mathematical. If you manage hundreds of millions and you believe there is even a small chance of systemic shock, you insure against it. That is likely what this is. Now let's talk practically for gold and silver investors. Should this trade change your strategy? In my opinion, no. Serious gold and silver investors should focus on fundamentals. Watch real interest rates. Watch central bank policy. Watch global liquidity. Watch debt expansion. Watch currency strength. These are the drivers that matter long-term. Short-term option positioning can create headlines. It can create excitement. It can create speculation. But disciplined investors build positions based on macro trends, not rumors. If gold gradually climbs due to monetary debasement, that is sustainable. If gold spikes because of panic, that is volatile. Both scenarios are possible, but neither requires secret insiders. As for silver, remember this. Silver tends to amplify gold moves. If gold were to enter a true monetary reset cycle, silver would likely react even more aggressively due to its smaller market size and dual industrial monetary role. But again, that depends on real macro shifts, not social media speculation. The key takeaway here is balance. We must stay open-minded. We must analyze data. But we must avoid jumping to conclusions. The market always produces anomalies. Sometimes they mean something big. Sometimes they are just hedges sitting quietly in the background. Right now, the evidence leans more toward institutional insurance than insider front-running. That could change if we see confirmation across bonds, currencies, credit spreads, or central bank policy announcements. Until then, it remains an interesting but not decisive signal. If you want clear, logical, no-hype analysis on gold and silver markets, make sure you stay connected with Gold Silver Scope. We focus on real data, macro trends, and disciplined thinking. Because in precious metals, patience and perspective matter more than excitement. And finally, a short disclaimer. This content is for educational and informational purposes only. It is not financial advice. Always do your own research and consider your own risk tolerance before making any investment decisions. Stay sharp, stay rational, and I'll see you in the next analysis.